Well, Happy New Year, Ron.
Yeah, Happy New Year, Tim, and everybody. Hello.
Yes, Happy New Year, everyone. Great to have you back.
Thank you.
Great to have you here, and great to have you managing our portfolio. In fact, we're super excited about the results. Can you tell us a little bit about your current results versus, say, the S&P 500?
So, yeah, 2022 was a really difficult year all around. Took a lot of people by surprise, and there's a lot of things that happened that were unexpected, and so there was that hit the markets pretty hard.
Absolutely.
On average, if we look at the typical 60-40 portfolio, the average 60-40 portfolio was down around 18-19% for 2022. Our 60-40 portfolio within our models was down about 11%. So
awesome.
We were able to only lose about half of what the market did.
That's what it's all about, lose less, right?
Exactly, because it's much harder to make up those things. It's psychologically and financially, it's much easier to deal with missing out on a little bit of gain, because there's always another opportunity ahead to make that next gain. Right. But getting hit with a loss takes you down, and psychologically, psychologically that hits too. It makes it harder to get back into the game. So that's one of the things that we have to watch for as we come through the cycle and through the market bottom, is getting back in. And if you remember how bad it was after the financial crisis and the 50% down in the markets,
absolutely,
there was a lot of people that could not get back into the market.
And missed out on a lot.
Yeah, they waited about a year before they finally had the courage to get back in, and they missed out on really significant gains in doing
that. That's a really big point, because last time we were talking that we were in a recession, but no, technically they haven't come out and said it, but we felt like we were kind of there.
Right.
In terms of economic cycles, where do you feel we are now?
I would say we're still in, just like last time. If we look at our economic cycle, we divide it up into 6 stages between the expansion and contraction. And right now we are in stage 5, which is an early recession. Stage 6 is just the whole thing. That's a real recession. And then we hit back to stage 1, which is early growth.
Because
we're going through that cycle. What's keeping us back right now from going into stage 6 is really just 2 things, but they're pretty important things. And one is serious contraction, or that doesn't have to be serious, but a real contraction in economic growth. So we got to see GDP with a negative print. And also, and most importantly, really right now, is a significant rise in unemployment. And that's the big thing that is confusing everyone right now.
But we're not seeing that.
We're not seeing. In fact, we're seeing the opposite.
Right. It's almost like even, basically, right?
Well, the jobless claim numbers. I watched the weekly jobless claim numbers to get a really fine-tuned view of what's going on. And for those numbers, there's a break-even point of about 270,000. So if we have more than 270,000 jobless claims, that means we're losing jobs. If we have less than 270,000 jobless claims, that means we're actually creating jobs. And that number has been going down for us. 2 months ago it was 190. 2 weeks ago it was 190. Last week it was 186. This week it was 180, I think. 180, 183, somewhere in there. So we're actually still creating new jobs in the midst of what we all feel is really a recession. And that is why it is so confusing right now.
No, that definitely is. And one of the things that everybody wants to know about is, what is the Fed doing? What are the plans for interest rates, right? We've had some considerable hikes.
Yeah.
We just had another increase. So what are your thoughts on the Fed and interest rates?
Yeah, so the Fed just yesterday raised rates by 0.25%, which was exactly as it was expected. And they came out in their statements, and they're very clear that they expect to have at least a couple more rate hikes. And they have absolutely no plans whatsoever to start cutting rates anytime soon.
Because it's not a short-term thing. You were telling me yesterday as we were kind of hanging out, you were telling me it's going to take time for us to see the effect of the interest rate increase in terms of inflation.
Right. It takes time for these things to work their way through the economy. So we're just now seeing the effects of what they started with.
Right.
So that one of the things that the Fed wants to do is to get to a point where they feel it's truly restrictive policy, where it's really going to slow things down, and then hang there for a while. And
let things cool out.
Yeah, let things cool down. Because as much as we like to see the numbers, the inflation numbers that we're seeing come down, we've gone from a CPI or a PCE, which is the Fed's favorite number, of about 8% down to 5%. That's a really nice thing to see that it's come down that much. But 5% is still 2.5 times what the Fed's target.
I was just going to ask you the target number.
Yeah, the target number is 2%. So
right.
5 is 2.5 times that, which is just way, way too high. So they're still fixated on that. And, I expect we're going to see the Fed funds rate between 5 and 5.25% for a while.
Okay.
And then we'll see where it goes from there.
Do you think that they're going to probably taper off with the raising by third quarter? Do you think we'll be done with raising rates by that time? We need to wait, like you said, but do you think we're kind of done with the raising of the rate?
Yeah, I think we have one more at least.
At about
probably
25?
Yeah, two more 25 basis point, 20 quarter point hikes. And then that'll probably be their pause point.
And then let things just kind of cool
settle
down, settle, see what happens.
Right.
And then revisit. Because
Exactly.
if they revisit too early, that could be a major problem, right?
Exactly. If they start cutting. So the Fed they made that mistake in the 70s. In the mid 70s, we had a run up in inflation, and the Fed did their job. They raised interest rates, and we started getting that inflation under control. In 74, 75, we had a recession. And so they started cutting rates in order to stimulate, to help us get out of the recession. But it was too soon in terms of what was going on with inflation. And though inflation did come down for a bit, it was very short-lived, and then it went up.
Overcorrected a little bit.
Yeah.
It's kind of like driving down the road, you swerve to miss the object in the road, then you're grabbing the steering wheel and yanking it back, and you might go off the road and end up in a ditch if you're too aggressive with it.
Yeah, exactly.
So you have to be very cautious as to when you swerve and when you pull back. You don't want to overcorrect.
Right.
So
Right.
in terms of the Fed, they have to really watch when they say, okay, we're going to lower interest rates, because it could have an adverse effect. It could be
Right. Yeah. If they go too soon, they're literally terrified of making that same mistake again, because it took Paul Volcker coming in and raising the Fed funds rate over 20% to over 20%. Can you imagine? We're not quite at 5% right now.
Right.
Imagine it at 20%. We had 18% mortgage rates during those days.
But it's happened.
Yeah.
And
so they're
it's something
afraid
to be
of that.
aware of, because that's why they're being cautious. And so
Exactly.
synonymous with interest rates is the conversation of inflation itself.
Right.
So have we hit that peak? Are we done with inflation? Is it starting to taper? You mentioned that their indicator, I think you said the PCEs, they were at 8 and now they're at 6 or
5.
Yeah. So that's showing a positive.
Right.
So does that mean that we've hit our peak as far as inflation, and we're starting to come down some, and it's going to take time, or we still have more to go?
I think the realistic view is, yes, we've seen the peak, we've seen the high point, but it takes time for inflation to dissipate.
So we hit the peak, though.
It looks like we hit the peak. There's enough things that are coming out that show that we've probably gone past that. And that's not necessarily because of what the Fed has done alone.
Right.
We've seen a lot of restoration of services in the supply chain. So that's loosened up.
COVID had tightened everything up. You couldn't go get a PlayStation. You couldn't get the car that you wanted. You couldn't do anything.
Or toilet paper.
Or toilet paper. Absolutely.
Shortages.
So now these supply chains have gotten looser, easier.
They're loosening up. China
regardless of the war,
too,
right?
Exactly. Yeah, that hit the oil and gas prices. So all those things, these things are starting to flow more freely again, and that helps to bring the prices down. So that's just part of the equation. The Fed now is focusing more on, that's the goods side. So there's a goods side and there's a services side. Goods are more naturally self-correcting, like what we've seen. As you know, I know you studied this. And services is stickier, tends to be stickier inflation. So there's a new measure that they're using out now, and what they're doing is they're taking service sector inflation and subtracting food and energy costs.
Okay.
And they're using that as a gauge to see where we are for inflationary pressures. And that's very sticky. It's staying up there. And that's what inflation does generally.
Is that PCE you were talking about?
Well, this is a different indicator.
A different indicator?
Yeah.
But they have an indicator that's a little bit more refined
right. The
to try to
Fed
find that
uses it.
service
Exactly.
stickiness, if you will, as you were saying.
Yeah, exactly. And the only way that can really come down is if we have enough financial constraint.
Right.
Financial conditions have to be tight.
As things are tight, we have something that we have to worry about, which is the national debt.
Right.
All of you know, we talk about that all the time. I talk about it on the seminar, I've talked about it on the radio, what have you. National debt is a huge thing, and especially relative to our income tax. And we have this ceiling standoff.
Right.
So are we going to need to be concerned that the U.S. could go into default and lose some of our credit rating and lose some of our financial power, if you will? Or do you think that we'll maintain because we're still the number one in the world? Right.
Very good question. So there's a couple of things there. One is the primary concern is will the U.S. default on its debt? And you have to be very careful and understand really what a technical default is. And that means that we don't pay our interest or principal payments. Will that happen? Is that a real possibility? And the reality is this: we took in enough revenue and taxes through last year that the debt service, so the interest on our national debt, was only 9.7% of how much we took in terms of tax revenues.
Okay.
So are we in danger of actually not paying those income payments?
Not at 9.7%.
No, we're safe there. And as far as paying the principal, we can actually just roll that over, even if the debt ceiling is never raised, because if it matures,
that's just kicking the can down the road.
If a $1,000 bond matures, they just do another $1,000 bond.
Pay the minimum on a credit card, basically.
It's just like a household.
It might not be the best idea,
no.
but it stops you from going bankrupt.
Right. But just like a household, now there's an issue we have to face, and that is we can't get more money. Our income is limited.
We have a limited amount of money.
So now what are we going to do? And the only answer there has got to be you have to cut costs somewhere. And that's the political problem.
Cut cost or raise taxes to increase that way. It's got to be one of the two.
One of the two.
And you think we're coming to a head of that? That conversation has been talked about for the last 10, 15 years steadily.
Sure.
Right? And we talk about it, or Social Security changing in 2036 to where it's a loss of 25%, and all these different things you hear about, and it's like, oh well, it's almost become like a not in my backyard policy where like, it's not really affecting me right now, so I'm not really worried about the national debt 27 trillion. In an actual math-based conversation, and just talking about it, and you're looking at the facts, it's very scary. But in the general populace, I don't think people are really worried about it yet. Do you think we're starting to come to a head where we're going to have to, as we have more of a tightening of the fiscal policy?
Yeah, I certainly hope so.
Okay.
And this is where it's got to actually start hitting people.
The rubber hits the road at some point, right?
So how likely is the possibility that there will be cuts in entitlement programs and the like, and or tax increases as we're going into a recession? So this will give it some bite when these things hit, and people will be paying attention. So I'm hoping that will help to push the politicians into the right places.
There's a huge thing happening, 2026.
Yep.
The tax code goes back to where it was pre-2017.
Right.
So that would be a spot where you could start seeing the rubber hit the road. Would you agree that could be
that's going to be
policy there that starts to control that a little more?
There is time for that, so something could happen.
Sure.
But that would certainly be a big one. Even closer, thinking about this year, all the COVID stimulus things are done.
Right.
All of the tax credits.
They've run out of money, actually. I've heard in the real estate markets where people would claim that they couldn't pay their rent, they need help. They've run out of money.
Right.
There's no more money to give.
Right. The programs are done.
The programs are.
And so
are
when
done.
people are
Yeah.
going to be filing their taxes, I think there's going to be a lot of surprise out there.
Of what that looks like. for
Exactly.
income.
People
Yeah.
are going to be thinking, I should get a refund, and could
You're
very
used to a
possibly not.
$5,000, $6,000 refund perhaps,
Right.
and now you're not because of your credit that you got through the COVID stimulus and things like that.
Right. And those tax credits that you took on your 1040 last year
Yeah.
don't exist anymore.
Absolutely.
So that's going to be.
So they're going to slowly. It sounds like the writing's on the wall there.
Yeah.
Now's the time to start really looking at that, especially as the Fed is supporting that as well by not fooling around with the interest rates or really trying to get things under control, which is the right time to start talking to the rest of America, I would think, hey, we need to get our debt under control as well. So unfortunately, ladies and gentlemen, we may be having some tax hikes here soon to be able to offset the debt because we just can't keep kicking it down the road.
Right.
Well,
Very much.
when we look at all this settling out, right, and we talked about interest rates kind of peaking out, maybe one or two more hikes on that. We talked about inflation is starting to go back down now, but yet volatility is still there. Do we feel that we're in for more volatility? Do you think we're going to kind of balance out? You mentioned earlier that we're going to be back on a trajectory, resetting the economic cycle, going back to stage one, and that's where all the money's made, so we're all excited waiting for that, of course,
Right.
Ron. So
Right.
when do you see, everybody wants to know, when are we going back to stage one?
Yeah.
And I know you don't have a crystal ball, but
No.
we can all look at the indicators, but what are your thoughts?
Right. That's a really good point. I'm glad you brought that up because this tends to be a dangerous point in the cycle.
Okay.
People get tired of waiting, and it
Okay.
starts to wear on you. And there's sort of an exhaustion that takes place as we're waiting for things to turn around, and you start to look at what can I do to make something happen. And individual investors typically will start monkeying around with their portfolios in order to try and force something to happen. And what happens in highly volatile times like what we have right now is most often you end up zigging when you should be zagging, and you make
Right.
exactly the wrong call. You
hurts
sell
people
something
more.
when you should be buying, or vice versa, and it makes the situation even worse. So this is a time when you have to be patient and you have to have a plan thought through.
Which is difficult.
Yeah, it is difficult.
And this comes from you. You're saying this is difficult. So for someone who worked their whole life and saved up X amount of dollars and is self-managing it, it almost seems like it's borderline impossible in today's environment.
Right. And it really is. The part of the problem is now, in the time that we live, now you can turn on TikTok
Right.
and find 12 experts on
On stock
on
trading and everything.
right?
Yeah.
And they're giving you all kinds of ideas that some may just absolutely destroy
Yeah.
what you're doing. When people ask me what I do and what my credentials are and things like along those lines, I tell them I'm a chartered financial analyst, and people say I have no idea what that means.
Right.
And my favorite reply is, well, I help people to not blow up their retirement.
That's a great one. Yeah,
Yeah.
we agree with that 100%, Ron. Absolutely. Well, I appreciate you taking the time today to go through these key questions. We know you're a busy man, and you're always putting your time into the portfolio and analytics, but this is great for our clients and maybe potential clients to be able to listen and hear a true analysis of what you think the market is doing from a verbal standpoint. I know you do a wonderful newsletter and it's very detailed, and all of you, if you're not getting that, please make sure you are getting that, and you can call our office to ensure that that happens at 757-961-0700. Anybody there will help you with that. But Ron, again, thanks for your time. I'm looking forward to the next time we get to sit down and chat again.
Definitely. Thanks, Tim.
Take care, everyone. Bye.